Hello, fellow traders. 'Tis I, the Rumpled One, coming to you Sunday, March 31st, the year 2019. Let's talk trading, weekly open and gap. Last trading, see, actually, it's really the first trading day of April, but because where I live here in the U.S., it's still March. But be that as it may, money and risk management, whether it's the last day, whether it's the first day, whether it's any day you're trading, you have to focus on your money and risk management. Yes, we will beat that dead horse. Okay, it's weekly open and gap time here. As you can see, you have plenty of gaps that haven't been filled already. And some of these gapped up huge, some gapped down huge. Hopefully, you'll get to take advantage of some of these gaps. Now, since we're talking about having a new take, not doing the trading like a pro this month. We're going to be looking at the different systems that I've come up with, and we're going to start out with the buy zone, simply because that was the first system that I came up with. And it was originally developed or invented, created, discovered for the stock market, but it also works with the Forex market. In fact, it works with any market. Now, what is it? What is the buy zone and why does it work? Well, let's look at the range of a pair. And as you know, I like trading euro yen now, basically because of its range. I was trading dollar yen, but I switched over to euro yen. You might ask, why didn't I trade pound yen? That was just too crazy. At least for me, for the most part. So, if you look at the frequency distribution, you can see, well, let's look at the last 100 days. But you can see how many times it's been 30 to 39, 40 to 49. You can see the distributions heavily weighted towards the top, usually over 50 pips, 50 or more pips, right? 60 or more, 70 or more pips. Oh, what, 62% of the time? So that means price has gone from open to high to low. The distance between high and low is 70 pips or more. Okay? That's what we're saying. So from this line, if you add these up from above, distance is more than 70 pips, high to low, in a day. So, okay, so big deal, right? Yes, it is a big deal, simply because when you look at the buy zone, I need to switch the time frames here. So I set up the buy zone. Open plus 10, open minus 10. If we know it's 70 pips, there's no way 70 pips can fit within a 20 pip range. It's either going to come out the bottom, come out the top, or come out both sides. That's just physics. That's just math. I mean, you can't fit 70 into 20. It just doesn't work. Knowing that, all you have to do is trade away from the open. And you know you have a potential win, either going long this way, or going short this way. And you can see here we've got this pivot way down here. So we had a bias of a short bias. So we got triggered, it came back down. And here we go. You see we had a low, put in a new low, came back the other way, closed, tried to get it. So right here, you should have taken profit. I mean, this is just simple. This is about as simple as you can get when it comes to trading, in my opinion. And we know it's best to trade at or near the open, because if it's already come down here and already gone up there and you're somewhere in the middle, pretty much the game is over. So you want to get in at near the open price. And why do we have these triggers so far away? Well, part of the reason is mainly that was from the stock market, not so much Forex. But you want price to be moving a certain direction so you can say yes. Otherwise, you just want to, if you're just taking the last cross from the open, people always talk about, well, you get the whipsaw, blah blah blah. Yeah, if you try that, yeah, you could get whipsawed. I mean, all you have to do is come down here. Not so much today, but you can see here price came down. That would have been a nice trade. With the one exception, probably the spread at this time was pretty huge, and you might not have been able to exit at this price. So you see here, you got just crossing that weekly, daily open. It pays off. And that's pretty much it. It's based on statistics. And usually when people, once they get it, they go, oh yeah, it hits them like a ton of bricks. The light bulb goes off, and then they try to implement this in their own trading. So for example, today, you can see here, high minus close is already 12, and close minus low is already 8. So that's the close. But what we want to know is, what was the high minus the open? Okay. So you look at the open price here, 124.65, and the high was 124.66, so that's all of 1 pip, but the low is 124.46, and that's what, 19 pips. So you can see we've got a range of 20. So chances are, by the end of the day, based on the range, that's not going to hold. Most likely it's going to get up to 30. Now that's only 100. And people go, oh, that's not enough. That's not enough. And you know what? Really, it's not enough when you are developing a system. But the reason I have it set to 100 is because I want to see if those numbers start to shift. In other words, are we shifting to the downside, or more, or is it lately more down here than up here? And if you just take a quick look at these on a daily basis, just like if all of a sudden one of these zeros turned into a 1, it's like, whoa, where'd that, how'd that happen? What happened yesterday? What was going on? And you can just see if these numbers are starting to drop off. But we could crank this up. I think it's 5,000 is the most we can have. So you can see here, no, it wasn't 5,000. You're getting some ridiculous numbers there. So maybe it's 2,000. I don't know how much data. Well, it seems closer. I'm not sure the zero. Bad data. That's about 4 years worth of data. That's probably why. Yeah, that's it. So you can see here a range of 20. It's just not likely. I mean, it could happen, but it's just not likely. So that means price will leave the buy zone area open plus or minus 10 pips. Or you can always tighten it up. That's up to you. You could tighten it to 7 pips. You could tighten it to 5 pips. You could tighten it to 3 pips, whatever you want to make it, because once again, you have got range statistically on your side that price is going to move. So that's the buy zone. And you can take a look at other pairs. Let's see. Pound dollar. You can see what happened there. The euro dollar. You can see what happened there. So you see movement around the open, but hasn't quite hit the buy zone. Now we can do the pound yen, and you can see here some of the price action. Open lines, you can use the monthly opens for the various months throughout the year and just keep an eye what happens around them. And once again, we've got the range. You can see here it's early in the day, not much range so far. And here, close open, anything in the magenta, that's definitely close to the buy zone, or actually close to the open. I think I have a 5 pip threshold set there. And pivot points and buy zone. Once again, we use the pivot as a directional bias, so we want to trade towards that pivot. So you can see here, going short, we're trading towards the pivot, and it's also gapped up. So there's 2 strong short biases that hopefully we can exploit for profit. Now, why would I show the wick zone if I'm talking about buy zones? Remember, the wick is the candle, is the distance between the candle top and the high. Well, that candle top could be the open. Ditto for the other side. This is the candle bottom. This is the candle low. So the open could be this price, because usually, except on the opening day of the week, the Sunday, Monday, that's when you get the gap. But for the rest of the time, you're looking, close and open are usually about the same. And just the tick chart, just because it's the tick chart. But once again, looking at the buy zone, you can say, you know what? Price is only range 20 pips. We know it's going to range 30. So if it's here, I know price is going to move away from me. From when I first opened this chart, it could move up, it could move down, it could move up and down. But we know it's going to move away from this. It has to. We don't have enough range yet for the day. Now if there's some news that shuts down the market, some black swan event, that could happen and we don't get the range. But, that's not very probable, though it is possible. But you can see this is your own buy zone. This is when you open. This is your open when you first started looking at price, and you can see what it'll do. And I have it set basically 1 spread. If it moves 1 spread, or maybe it's 2 spreads. Maybe it's 2 spreads on this pair. Then that's what I'm looking for. If it moves 2 spreads in one direction, I'm thinking chances are it'll keep going. We would have either buyers or sellers controlling. So I hope that gives you a good overview. Feel free to ask questions. We're going to be looking at the buy zone for the entire week. And then next week we will shift to a different system. So remember, fellow traders, when you're trading this week, it's not what you trade, it's how you trade it. So let's get out there and drain the banks.